Okay, so welcome to lecture 16, and in this lecture we're going to be looking at liquidity sweeps, which is something I actually briefly touched upon in the last lecture when I was getting into a little bit more detail on what we're looking at in smart money concepts, okay? And liquidity sweeps is, I'd say, one of the most important concepts for you to grasp, and I'd even say one of the easier concepts for you to grasp as well, okay? So the idea of a liquidity sweep, as I touched upon in the last lecture, is to identify areas in the market where you'd expect liquidity to be from your average retail investor, okay? And this liquidity often comes in the form of stop losses, okay? So as we know, a stop loss, what happens when your stop loss gets triggered is it executes an order and provides liquidity to the market. So let's say you enter a long position, you place your stop loss below this support level here, so these two wicks creating a support level. You place your stop loss just below and you're hoping for price to go up. When the price comes down, if it does trigger your stop loss, your position will be sold to the market, okay? It'll be sold to a buyer, and you are creating liquidity for the market. So the idea of a liquidity sweep is to identify where traders who would trade like that would be placing their stop losses, so you could take advantage and try and see where somebody, a smart money trader would be looking to get involved in the market, rather than your ordinary retail investor using more simple analysis, okay? So in this example here, just as I was saying, you have these two wicks which are relatively close on the 4-hour time frame, okay, so a high time frame. We're forming a bit of a support level here, and we can say these lows are equal, okay? Obviously they're not exactly equal. There's a small difference between the lows. So if you look up at the left, we can see this low was at 21,424 and this low was at 21,441. Okay, so not perfect, but low enough that we can mark them out as a liquidity level, okay? And I have a tool for that where I just put $3 signs like that to indicate that I'm expecting this level to have liquidity underneath, as people will use this to place their stop losses, okay? This level also lines up with a previous resistance level, which is now, expected to turn into support. And, at the time I was still expecting this to hold as support. Again, there was various reasons for me to think this was a good idea to buy here. So this is, me using those other concepts alongside smart money concepts, just, generic support and resistance. But what I wanted to see was a liquidity run, is what we call it. When price comes down, it hits the stop losses of the traders who put their stop loss under here, and then reverses after, okay? And if we watch what happens, we can see on the candle, the next 4-hour candle after this one, price comes back down, it takes out the people who put the stop losses under here, and quickly reverses because some smart money buyers have come in to pick up the stop losses, okay? So to buy the sell orders that are executed down here, and price quickly reverses and is going to look to start a new trend in price action, okay? And as we can see, if we follow that through, it really starts to take off, okay? And this was a very, very large move for Bitcoin, which actually continued way up to the 30k level. Okay, and here we have another example of the same kind of principle, where we have some lows which are fairly equal, on a higher time frame. You're never going to get them perfectly equal, but as we can see, fairly close, and we can assume that there will be traders starting to use this for a stop loss to place under here for a potential move to the upside, okay? And if we let this play through once again, we can see a quick volatile move down that will take out a lot of the stop losses that were placed underneath these lows, and a pop back up. And if you see a wick like this, so you see price quickly comes down then sharply reverses, this is indicating to us that buyers have started to come into the market. The larger buyers have started to take advantage of the stop losses that were placed under here. They've bought into the market, price has quickly reversed, and offering great opportunities to grab long entries when you see this occur. And this is actually, part of a strategy I call reclaim strategy, which will be getting into in one of the later lectures. But, it's a fantastic thing to look out for, these, relative equal lows, wick underneath, rejection, sharp move back above. And this is basically indicating to us that the people who were placing their stop losses, incorrectly down here, bad stop loss placement, gets taken out by the market and bought up once again. Okay, so in this example, I want to show you a kind of a different approach to this, where you don't always need to have two equal lows or equal highs to find a potential liquidity level. Okay, so what we see here is a sharp move up for Bitcoin, where price has rallied very aggressively, culminating in a bit of a pullback and some consolidation here. Okay, and what tends to happen in consolidations like this after a strong move up is people, just get into the mindset of, okay, this must come down now. We've moved up really aggressively. We've hit the 30k level, which, a lot of people wanted to sell at the time. There definitely was supply coming into the market here, so there were sellers coming into the market. But what happens when you get a consolidation like this after, an isolated high like that? So you come back, you consolidate, is you will have retail traders getting into short positions here, expecting a retracement to come down and kind of like rebalance the move, okay? Because, obviously price can't go up forever. There must be some downside to come, and traders want to take advantage of that. And what can often happen, okay, is before the downside move does actually occur, if you get a high like this followed by a bit of consolidation, you allow the short positions to build up, there will be another liquidity run, okay? And this enables smart money to get their sells in where other traders are placing their stop losses, because the people who are, randomly building short positions here, they're probably going to use the last high as a potential, stop loss. Okay, so they might do something like this. They'll get into position down here. They're going to expect it to come down, much lower to retrace a lot of the move that's already happened, which does, sometimes occur. But what can often happen is, instead of coming down like they hope for, you get another liquidity run. And if we see what happens here, we see price continues to consolidate, and then in one wick like that, we see yet again, similar to how we had the equal lows, you had a quick sharp run up to liquidate the short positions here, which was followed by a quick rejection back below. And you can make some fantastic trades out of this if you get good at spotting when these occur. Okay, so you see this was very obvious here. And this would also, when price broke this level, people would also be getting into long positions, which means they would buy, which means this gives more liquidity to sellers in the market, the big money sellers who want to get out. This is a perfect spot where there's going to be a lot of liquidity generated very quickly. They can sell into. When you see price closing back below, it gives some great opportunities to start looking for the short positions after the liquidity run. Okay, you don't want to be building it here. You want to wait for liquidity to be ran, rejections back under low, and now we're starting to get into some of these strategies and some of the tactics that I like to use to find and execute on my trades.